There's a story that circulates in certain corners of the internet, told and retold in financial forums and real estate communities, about a man who built an empire on borrowed money and lost everything in a single weekend. His name was Marcus, and by the time he was 37, he controlled 14 rental properties across 3 states, a portfolio that looked extraordinary on paper, with a combined value approaching $11 million. He had followed the playbook perfectly, the one that gets repeated endlessly in investment podcasts and wealth-building courses, the playbook that says, leverage is the secret weapon of the wealthy, that using other people's money is how you accelerate your path to financial freedom. He had put down minimum deposits, maximized his debt-to-equity ratios, and refinanced aggressively to pull out capital for the next acquisition. His friends admired him. His family thought he had cracked the code, and for a while, he believed it himself. Then the market shifted, not dramatically, not catastrophically, just enough. Vacancy rates climbed slightly in 2 of his markets, interest rates adjusted upward on his variable rate loans, and a major tenant in his largest property declared bankruptcy. Within 6 months, his cash reserves were gone. Within a year, he was negotiating short sales. Within 18 months, he had lost everything, except the knowledge that the leverage that built his empire was the same leverage that destroyed it. This is not a story about market timing or bad luck. This is a story about a fundamental misunderstanding of how wealth actually works, a misunderstanding that keeps millions of investors trapped in a cycle of risk they don't fully comprehend until it's too late. The mythology of leverage has become so deeply embedded in modern investment culture that questioning it feels almost heretical, like doubting gravity or suggesting that compound interest isn't the 8th wonder of the world. We've been taught that wealthy people use debt strategically, that the rich understand how to make money work for them by borrowing against assets, that leverage is the tool that separates the sophisticated investor from the amateur who keeps everything in cash. And there's a kernel of truth in this narrative, enough truth to make it dangerous, because it takes a principle that applies in very specific circumstances and generalizes it into a universal strategy. The wealthy do use leverage, but not in the way most people think, and certainly not with the frequency or the ratios that get promoted in real estate seminars and investment courses. When you study the actual behavior of ultra-high net worth individuals, when you look at how families that have maintained wealth across generations actually structure their holdings, you find something quite different from the highly leveraged maximum efficiency portfolios that get celebrated in investment media. You find conservatism, you find patience, you find large cash reserves and low debt ratios, you find a completely different relationship with risk than the one being taught to people trying to build wealth from the middle class up. The fundamental deception embedded in leverage culture is the conflation of velocity with wisdom, the assumption that moving faster toward wealth is inherently better than moving more slowly. This is where the trap begins, in the belief that time is your enemy, that you need to compress decades of wealth building into years, that the opportunity cost of holding cash or moving cautiously is greater than the risk cost of being overextended. This mindset serves the people selling leverage products beautifully. It serves the banks that profit from loan origination fees and interest payments. It serves the real estate gurus who need you to believe that their system of maximum leverage and rapid acquisition is the path to freedom. But it doesn't serve you, not if your actual goal is durable wealth rather than impressive-sounding asset valuations. There's a Bloomberg article from 2 years ago that analyzed the portfolio composition of family offices managing more than $100 million, and the findings were striking in how dramatically they diverged from conventional investment advice. These families held an average of 23% of their investable assets in cash and cash equivalents, not temporarily while waiting for opportunities, but structurally as a permanent feature of their wealth strategy. They carried debt levels that averaged less than 15% of their total asset base. They prioritized liquidity over yield, optionality over optimization, and resilience over maximum efficiency. These are the people who have already won the wealth game, and they play it completely differently than the people trying to win it. What wealthy people understand about leverage that most investors don't is that debt doesn't just amplify returns, it amplifies consequences. It amplifies everything. When markets move in your favor, leverage makes you look brilliant. It accelerates your wealth accumulation and validates your risk-taking. When markets move against you, leverage eliminates your options. It forces you to make decisions on someone else's timeline. It converts temporary market dislocations into permanent capital losses. The difference between owning an asset free and clear and owning an asset with 70% leverage isn't just mathematical, it's existential. If you own a property outright and the market drops 20%, you've experienced a paper loss, uncomfortable but not urgent. You can wait for recovery, you can continue operating, you can make decisions based on long-term value rather than short-term pressure. If you own that same property with 70% leverage and the market drops 20%, you're now underwater, your equity is gone, and if you face any kind of cash flow disruption, you're in a forced sale situation. The leverage didn't just reduce your returns, it fundamentally changed your relationship with the asset and eliminated your sovereignty over your own financial decisions. This is what Marcus discovered in real time, that the properties he thought he controlled actually controlled him, because the debt obligations attached to them dictated his choices more than his own judgment or strategy. The mortgage industry and the real estate investment complex have spent decades normalizing debt levels that previous generations would have considered reckless. The idea that you should put down 3.5% on a primary residence, or 10% on an investment property, or 0% using creative financing techniques. These ideas aren't presented as aggressive strategies for sophisticated investors who understand the risks. They're presented as standard practice, as what smart people do. There's been a systematic cultural shift in how debt is perceived, from something to be avoided except in carefully considered circumstances to something to be maximized as a wealth-building tool. This shift didn't happen organically. It happened because financial institutions make enormous profits from originating loans and servicing debt, and they've been extraordinarily successful at convincing people that carrying high debt loads is not just acceptable but optimal. The result is that entire generations of investors have built their wealth strategies around assumptions about leverage that have never been tested by a real financial crisis in their own experience. They remember that markets recovered in 2008, so they've internalized the lesson that you should always be aggressive because things always recover. This is survivorship bias, learning from the people who made it through rather than learning from the people who didn't. The concept of margin of safety, popularized by Benjamin Graham and Warren Buffett in the context of stock selection, applies even more critically to portfolio construction and leverage decisions. Margin of safety means building in room for error, for bad luck, for circumstances you didn't anticipate, for your own misjudgments. It means structuring your financial life so that you can be wrong about multiple assumptions simultaneously and still maintain your position. When you're operating with high leverage, you've eliminated your margin of safety. You need to be right about everything. Your income needs to remain stable. Your properties need to stay rented at projected rates. Interest rates need to cooperate. Your health needs to hold up. The economy needs to avoid recession. This isn't investing. This is dependency on circumstances beyond your control. And the wealthy understand that dependency is the opposite of wealth. True wealth is sovereignty. It's having so much margin that external circumstances don't dictate your decisions. It's being able to make choices based on value and opportunity rather than necessity and pressure. When Marcus was building his portfolio, he thought he was building wealth, but he was actually building dependency. Dependency on continuous rent payments, on stable interest rates, on his ability to refinance, on the market continuing to appreciate. The moment any of those dependencies broke, his entire structure collapsed because he had no margin. There's a powerful scene in Michael Lewis's book, The Big Short, where one of the investors who predicted the housing crisis is trying to explain to his partners why he's maintaining massive cash reserves instead of deploying more capital into their profitable bet against the mortgage market. His partners are frustrated because they're sitting on cash that's earning almost nothing while their thesis is playing out exactly as predicted. He tells them that being right is meaningless if you don't survive long enough to be proven right. That the cash isn't a drag on returns, it's the insurance policy that guarantees they'll still be in business when the crisis fully unfolds. This is the mindset that separates professional investors from amateurs. Amateurs optimize for maximum returns in favorable scenarios. Professionals optimize for survival in unfavorable scenarios, knowing that if they survive, favorable scenarios will eventually present themselves. The reason wealthy families maintain large cash positions isn't because they don't understand the opportunity cost of cash. They understand it perfectly. They maintain cash because they prioritize survival over optimization, because they know that the winners in wealth building aren't the people who make the most money during good times. They're the people who maintain their capital and their optionality during bad times. The identity shift that happens when you move from a leverage-based strategy to a sovereignty-based strategy is profound, and it's probably the least discussed aspect of wealth building. When your portfolio is highly leveraged, your identity becomes bound up with maintaining that leverage, with servicing the debt, with projecting success, with defending the strategy to yourself and others. You become psychologically invested in the narrative that you're smart, strategic, ahead of the curve. This makes it extremely difficult to exit the strategy even when warning signs appear, because exiting means admitting you were wrong, means accepting that the sophisticated approach was actually the risky approach. But when you shift to a sovereignty-based strategy, when you prioritize liquidity and low leverage and margin of safety, your identity shifts too. You stop measuring yourself by how fast you're moving and start measuring yourself by how unshakable your position is. You stop getting your validation from impressive-sounding asset valuations and start getting it from knowing that you can weather any storm. This identity shift is uncomfortable at first because you're moving against the cultural current. You're choosing to look less impressive on paper in exchange for being more secure in reality. But this is the shift that wealthy people made long ago. This is why they seem so calm, so unhurried, so unbothered by market volatility. The path out of the leverage trap isn't dramatic or complicated, but it requires patience and humility, two qualities that are in short supply in modern investment culture. It starts with honest assessment, looking at your actual debt-to-asset ratios, your actual cash reserves, your actual vulnerability to income disruption or market shifts. Most people avoid this assessment because they already know what they'll find. They'll find that they're more exposed than they're comfortable admitting. The next step is creating a plan to gradually reduce leverage over time, not necessarily eliminating it entirely, but bringing it down to levels where you regain sovereignty, where you can make decisions based on opportunity rather than obligation. This usually means accepting slower growth. It means watching others acquire more properties or make more aggressive moves while you focus on building cash reserves and paying down debt. This is the test, whether you can tolerate looking less successful while actually becoming more secure. The final step is rebuilding your investment approach around principles that prioritize durability, focusing on cash-flowing assets with low or no debt, maintaining liquidity that allows you to capitalize on opportunities without needing approval from lenders, structuring your life so that you can absorb negative surprises without existential consequences. This isn't the sexy path. It doesn't make for inspiring social media posts. It doesn't generate applause in investment forums. But it's the path that actually leads to the outcome that people claim they want when they talk about financial freedom, which is sovereignty, true independence from circumstances and other people's decisions. Welcome to Luxona Wealth, where wealth is built from the inside out.